Welcome to our YouTube channel, your gateway to financial empowerment. We're delighted to have you join us here, where we're dedicated to helping you unlock the secrets to financial success and empowerment. This channel is your one-stop destination for valuable insights, practical tips, and expert advice that will transform your relationship with money and pave the way for a brighter financial future. In Rich Dad Poor Dad, Robert Kiyosaki explains the concept of assets and liabilities in the context of personal finance. Understanding the difference between these two categories is crucial for building wealth. Here's a breakdown of assets and liabilities as discussed in the book. 1. Assets. In Kiyosaki's framework, an asset is something that puts money in your pocket or generates income for you. It's an item or investment that has the potential to appreciate in value or generate cash flow over time. Examples of assets include real estate properties that you rent out, stocks that pay dividends, bonds that generate interest income, a business that brings in profits, or intellectual property that earns royalties. Essentially, assets are resources that have the potential to increase your wealth or provide you with ongoing income. 2. Liabilities. On the other hand, liabilities are items or expenses that take money out of your pocket. They do not contribute to your wealth creation or generate income. Common liabilities include mortgages, car loans, credit card debt, personal loans, or any recurring expenses that do not provide a financial return. Liabilities decrease your net worth and can hinder your financial progress. Kiyosaki stresses that many people mistakenly label items as assets when they are actually liabilities. For instance, a luxury car might be seen as a status symbol, but if it's purchased on credit and requires ongoing expenses for maintenance, insurance, and fuel, it becomes a liability because it drains money from your pocket rather than generating income. Kiyosaki encourages readers to focus on acquiring income-generating assets that can help build wealth and cover their expenses, rather than accumulating liabilities that increase financial burdens. The key lesson from the book is to shift your mindset and prioritize acquiring assets that generate income or appreciate in value, while minimizing liabilities that drain your financial resources. By doing so, you can improve your financial standing and move closer to achieving financial independence.